We're going to do Facebook stock, Paul. Obviously, this one is a no-brainer in terms of like the size of this business is incredible. It's been owning the world for over a decade. And let's look at it. I'm sure that the numbers are off the charts. Market cap of Facebook. Let's do it.
$700 billion market cap.
Good Lord.
That's a big company. PE 28, so that's an X. However, I will say this will be one of those, I'm sure, the revenue is growing so fast that I don't think 28 scares me as much as it should scare people. So this is what I'm telling you when people out there accuse me of being too much about the numbers and not about growth. Growth is a part of value. This 28 doesn't scare me because I know Facebook has a lot of growth potential and has grown a lot in the past. So we will cover that as we're finishing up.
A profit margin for Facebook, Paul.
Geez,
it's
OP,
absurd. Yes,
36%.
good Lord.
I mean, this is insane.
Incredible.
It's insane. So it's really great. More power to them. Let's keep rolling.
All right, revenue growth over the past 5 years.
I wonder if this is going to be a check or not.
Are you kidding? All these numbers have to go crazy.
Yeah.
Look at that.
17 billion, 70 billion. That's a huge check.
I would assume profits are going bonkers
I
as
would
well.
assume the same thing, but let's go see how bonkers it's going. 3.7 billion to 18.5 billion.
Jeez.
10 years ago, it made $1 billion.
Now, it seems like every single year people say that Facebook's on the way out.
I know.
Every
Isn't it incredible?
year.
I don't go on Facebook as much as I used to. Do you?
I do not as well. We have a business there, but it's picking up with older folks, right?
Yeah.
I looked. There's actually last year it was 22 billion. It's 18 now. So.
Yeah. You want to look at that's why we look at the long run.
But profit is up, Paul. Of course. Let's go to shares outstanding, pillar number 5.
2.8 to 2.85. So an X mark there. X marks the spot for those of you who are old enough to understand that reference.
Oh, they're selling more shares.
They have more shares outstanding. Not by much though, Seth. Only about 1% more.
Current assets greater than current liabilities is pillar number 6. Good job, G.
$66 billion in cash.
Oh boy.
This is insane, guys. Current liabilities, $12 billion.
Oh boy.
Ready?
That's a check.
$28 billion in total liabilities. They have $40 billion more than they need to pay off all the debt for the company. So the company we had worth $700 billion, we now subtract 40 for a $660 billion market cap. In my head, it's $660 billion, which means our PE is no longer 28, maybe it's 26. I don't know what let's see, 40 of that is about 15%. So yeah, about 26 is the PE. But this is an important factor when you're looking at cash on hand versus total liabilities. It's enterprise value that we're looking at. Is awesome.
Benjamin says he loves Facebook. Let's keep going. Oh yeah, I forgot. Remember when Facebook bought Instagram for like $10 billion?
It was $1 billion.
It was $1 billion, right?
And I thought they were insane.
Right. Well, here they go.
This is why you don't listen to idiots like me.
Free cash flow growth over the past 5 years, Paul.
I'm quite sure this is gonna be awesome. We have 7.8 billion, and then last year they did 21 billion.
Oh my God.
Check mark there.
Okay, yes.
Is that number
And then
Yeah, number 7.
11.6, 17.5, and 25.3.
Okay, I've always had this question.
Go ahead, Paul. I mean, Gio, I love you.
That's Gio, I'm Paul.
For pillar number 8, what is that pillar?
We're going to get to that right now. So I'll tell you right now, G, great question. The free cash flow average of this company is 16.5. It's called 17 billion for free cash flow.
This company is growing very, very fast. This is a very fast-growing company. As you can see, their free cash flow has tripled in the last 5 years. So the question you need to ask yourself is, what do I think the future growth is going to look like? If you think the future growth is going to be equal to this growth, 25, I mean a huge number. Huge number, maybe 30, I don't know. That's the hard thing about this. Now, let me pull up my Excel sheet and I'll show you guys why this is interesting. My Excel sheet, guys, is my model. This will be part of the app at some point where you guys can actually put your own assumptions in and it'll tell you what you should pay for a company. But right now I have it in an Excel sheet. Look at Facebook here. The current price of, let me make this bigger actually.
So what we're trying to do, folks, is once we get that free cash flow average of 17 billion, we need to multiply it to get to the market cap that we think this company is worth. And then we'll compare it to the real market cap. And so, Paul, you were saying something like 25. I mean, 17 times 25 is 425 billion.
So it's still low, but watch this. The company's current price is $249 billion, $249 a share. I have it worth $230 if I want a 15% return on the low side. What does that low side mean? The average revenue growth the last 5 years has been 37%. it assumes that's cut in half to 18.5%. So according to this, if you think the next 5 years will have 18.5% revenue growth, along with keeping in touch with their 33% profit margin, you are okay buying it at today's price.
Okay, how is it only at 250 and then Tesla's like 800?
That's the number of shares outstanding. It's a totally different thing. So we will cover that after we do this. But as you guys can tell, everything is based on the assumptions you are making. Everything in investing is based on the assumptions you make. I can show you right here how Facebook is actually a pretty decent buy. On the low end, it's worth 230. On the high end, it's 650. I'd be paying 250 all day. The question you have to ask yourself is, are they going to grow at 18.5% a year in revenue for the next 5 years? What would that take their revenue to? That would take their revenue to $220 billion from today. $220 billion from today. That's a big jump. Is it possible? Absolutely. You have to ask yourself, is that probable?